Hey guys, welcome back to Smart Wallet and Me, where financial wisdom matters. In today's video, we're going to be talking about the market snapshot and what the stock market has for us for the coming week, because there's a major gut check because of earnings, the Fed meeting, and also the GDP results are coming in all next week, along with some major earnings for 118 companies. So let's get right into it. The coming week may present the closest thing to a reckoning for bullish investors so far in 2021. Everybody wants to buy the dip until the dip actually happens. Well, this might be your opportunity to buy the dip, because when fear grips the hearts of investors and they sell at a loss, they're no longer investing and using their brain, they're just going by emotions. A tip that many seasoned investors give is to buy the dip. And this week might test your guts and your resolve to buy the dip. It is going to be the busiest week of the fourth quarter earnings season, highlighted by hotly anticipated results from heavyweight companies like AT&T, Apple, Facebook, and Tesla. In all, there's going to be somewhere around 118 companies who are scheduled to report quarterly results in the final trading week in January, including 13 components of the blue chip Dow Jones Industrial Average, and about 60% of that weekly onslaught will play out between January 27 and January 28. This short period could shape up to be a pivotal one for a market that may be searching for its next spark as the new administration of President Joe Biden unfolds its policy initiatives and plans to tackle the COVID-19 pandemic. Thus far, optimism is sky high among equity investors, with sentiment data from Ned Davis Research at a reading of 74.4%, a level that has only achieved 7.4% of the time since 1994. Similarly, the bull-bear spread is at 19.3% versus a median of 4% as of December 31, according to American Association of Individual Investors survey. Ned Davis Research says that the buying mood has apparently crushed the appetite for bearish bets that stock prices will face a meaningful near-term correction. One thing that investors have been doing less of is short selling, wrote analyst Ed Clissold and Than Nguyen in a January 19 research report. According to NDR data, the short selling ratio, the number of shares sold short divided by the total issues traded, hit its lowest since 2011 back in November. One doesn't have to search long to find evidence of the treacherous path that short sellers are facing these days. One case in point is GameStop. GameStop is on track for its best monthly rise in its history, up 245%, as retail investing fanatics touted the stock and urged users on finance-oriented social platforms like Reddit to buy the shares to squeeze out all the short sellers. For some people, this is a battle between short sellers and exuberant long-term investors. In short, there's a battle going on between short-term investors and short sellers and long-term buyers of the stock market right now. Is this what the precursor to a bubble feels like, and are we in one right now? And when will it pop, if so? These are some questions that a lot of investors are asking themselves right now, and we will touch on them just briefly in this video. These questions are all the questions that may be put to the Federal Reserve when it provides the backdrop to the other major event for next week, the latest monetary policy update. The last time the Fed met, they indicated that they were not going to touch interest rates and they were going to keep them at low levels until 2023. If they continue to keep this policy, that would be good news for the stock market. And if they continue to stimulate the economy by making purchases, this will further stimulate the stock market. Fed Chairman Jerome Powell has often been blamed for both helping to prevent a calamity in financial markets during the onset of the coronavirus pandemic in March last year, as well as for fostering too much risk-taking. The Federal Open Market Committee, or FOMC, which Powell heads, rapidly slashed interest rates to near 0% and pumped trillions of dollars of liquidity into the financial market that had been rocked by COVID-19. But the Fed's policies have fostered some of the risk-taking on display that we see today, and some critics are arguing that shouldn't be happening right now because it is only blowing a bigger bubble that will come to play in a later date. Bears also make the case that the endless money printing will have consequences for the US dollar and for the economy and eventually financial markets as a whole. Yet in all of this, Biden is proposing an additional $1.9 trillion in federal government spending to help extricate the U.S. economy from recession as the coronavirus cases and deaths reach a new peak this month. All this may confer added significance to next week's Fed gathering. All eyes will be fixed on the Federal Reserve Chairman Jerome Powell at next week's FOMC meeting. We look for him to strike a more optimistic yet cautious tone, wrote economist Lida Bosur and Gregory Dacko of Oxford Economics in a Friday research note. In recent speeches, Jerome Powell has already indicated that the Fed isn't eager to pull back on monetary policy accommodation soon, including raising interest rates from historic lows or tapering its asset purchases. Just to be on the lookout, the Fed meeting kicks off on Tuesday with Powell and company delivering its policy update on Wednesday at 2 p.m. Eastern Time, followed by a news conference hosted by the chairman. On Thursday, a day after the Fed's decision, market participants will await the official report card on the health of the U.S. economy. According to consensus estimates among U.S. economists polled by MarketWatch, the U.S. economy may have grown about 4% on an annualized basis in the final 3 months of 2020, which would be phenomenal ordinarily, but comes on the heels of a 33.4% increase in the third quarter. Still, if the GDP reading continues to show upward progress, it may underscore that the economy is moving in the right direction even as the coronavirus pandemic continues to rage. If this continued growth continues in the direction that they are seeing, then there could be a potential drawback from the Federal Reserve to raise interest rates to slow down the stock market investing. After all that is said and done, if the Dow, the S&P 500 index, and the Nasdaq composite are still in spitting distance of record highs, the bulls may find themselves even more emboldened. In conclusion, I believe we still are in a bull market as long as the Fed is still increasing the debt levels and leaving interest rates low. However, the day of reckoning will have to come at some point where all this debt would have to be repaid and the huge bubble pops. I don't believe that day has come yet. The bulls are still ahead, crushing the bears, but that may change when the Fed changes its policy. Keep your eyes and ears on the Fed next week because that can change the entire ballgame for the stock market. We could expect to see some anticipation of people selling their stocks. We could see some prices of stocks going down, having a pullback, and giving us the opportunity to buy the dip. This is going to be that opportunity that we have all been waiting for. And when you see that dip, make sure you pile in into some real good stocks that have a good potential of high growth in the future. Let me know your thoughts in the comment section below. And please smash that like button for the YouTube algorithm and consider subscribing if you haven't already done so. I'll see you guys in my next video. Thanks for watching.